Happy New Year, everybody. I don't know about you, but I've been paying a lot more attention to ETFs in my portfolio in the past few years. Maybe it's because I'm in my 40s now and I'm kind of just more of a boring investor than I used to be, or maybe I just kind of want to build a backbone to my portfolio. In any case, I've been focusing a lot on ETFs, especially in my retirement portfolio recently. And there are a couple that are on my radar right now. Before we get into those, Tyler Crow is joining me. I'm going to let him talk about an ETF on his radar in just a second. But before we dive in, take a minute, click subscribe to my channel if you don't already, and take a minute, check out the link you see on your screen. You can get a message from our sponsor, The Motley Fool, the top 10 stocks to buy right now. It's the best way to support this work we're doing. So, Tyler, you are going to talk about a really interesting ETF with a really bad ticker symbol. What is it?
Yeah, it's the worst ticker symbol ever. It's EWW. Ew. But it's not because it's a bunch of it's not because it's waste or, like, I don't know, landfills or dumpsters or anything like that. It's the iShares MSCI Mexico ETF. So it's basically the total market index fund for the Mexican market. One of a little kind of peek behind the curtain, Matt and a couple other analysts at the Motley Fool, we all kind of just chop it up from time to time on a Slack channel. And I have been circling Mexico quite a bit recently, talking about like Mexican real estate, Mexican steel production, things like that, because in my view, number one, just in terms of economic growth, the Mexican market has been doing considered very well lately, and I think it's set up very, very well in the coming years, post-COVID, specifically because we've talked a lot about nearshoring and kind of supply chain resiliency and things like that. And Mexico has been one of the largest solutions for corporate America, corporate North America, if you will, on how to solve this problem. You're seeing massive investments in manufacturing, distribution. A lot of this is heading to Mexico as a way to, shore up supply chains, I guess, if you will, versus let's face it, like when you hear supply chain resiliency, it basically means we need to find somewhere other than China to build some stuff from time to time. And Mexico has been a huge beneficiary of this. And I see this continuing for some time. So you bring in all this industrial manufacturing, you have all this nearshoring going on, it's going to have a lot of knock-on effects. And specifically, that's going to have a lot of major benefits for the entire Mexican market. And it's something that I want to have exposure to right now. I've talked about an individual stock in previous videos, talking about Ternium because it's a major steel producer in Mexico. But I just want to grab a lot of the Mexican market. And one thing that has been really interesting me a lot in terms of investing lately has been looking outside the United States, because international market stocks are priced at extreme discounts and compared to what we see in the United States right now, almost at like historical lows relative to the United States. And just to give you an idea, like this particular ETF right now, on aggregate across its entire holdings, has a price to earnings ratio of 13 versus, what is it? It's coming close to 30, I think, for the S&P 500. So it gives you an idea of how cheap this is. Now, in terms of ETFs, it's because it's an international market, there's a lot of like foreign taxes and things involved. It's going to have a higher expense ratio than you'll get on like an American, at S&P 500. I think the expense ratio is 0.5%. Not the worst thing I've ever heard. It's certainly not a mutual fund, but when we're talking about ETFs in the United States that are less than 0.1%, that's not great. But if you're trying, you're buying foreign listings that don't have ADRs in the United States, can be an expensive endeavor for a lot of investors who may not have that in their brokerage. And so for me, that may be worth it for what I see as a very, very solid market in the coming years at a very cheap price.
Yeah, so one that I'm looking at right now, and it's similar to something you were talking about a few weeks ago on the channel, is the Invesco S&P 500 equal weight. It's got a 0.2% expense ratio, which is pretty nice for a specialized index fund like this. So the problem with the S&P 500, you've probably heard Warren Buffett's quote that the S&P 500, it's a bet on American business. And because of the weighting of the fund, it really hasn't been a bet on American business. It's been a bet on like 7 or 8 companies. So the equal weight S&P 500 kind of levels the playing field. It divides all the fund's assets among all 500 companies that make up the index equally. So a smaller S&P 500 component gets the same weighting as an Apple or a Microsoft. I call this more of a true bet on American business because you're betting on the 500 companies that make up the index, and they all count the same. So over the long run, the S&P 500 equal weight index has actually outperformed the S&P. That hasn't been true in recent years. It's significantly underperformed the market over the past 5 and 10 year periods. And the reason is the so-called Magnificent Seven stocks, essentially the largest companies in the market, have really outperformed. And personally, I think that the other 493 companies in the index have a lot more to gain from what is projected to happen in 2024, specifically lower interest rates. I think maybe one or two of the Magnificent Seven companies pay dividends, for example. So there's a lot of high dividend stocks in the other 493 that could be beneficiaries because high dividend stocks tend to be very interest rate sensitive. There's a lot of businesses that rely on borrowing in the other 493 more so than the big cash rich companies at the top. So their cost of capital will get lower. There's just a lot more that can go right for the other, 97% or whatever of the S&P 500 than the companies at the top. So I still like indexing. I still think this is a great way for most people to invest, at least partially, in your portfolio. But right now, I'm a much bigger fan of the equal weight index than I am of the regular S&P, and I'd like to play it with that ETF.
Just to add something to this, I don't quote me specifically on the numbers because I'm not 100% like correct on these numbers. But to this point, it was a fascinating statistic I saw is the S&P 500 equal weight index has a price to earnings ratio almost like 6 or 7 times smaller than the market cap weighted version of it because, like you said, the Magnificent Seven are trading at such spectacular premiums. We're talking Apple at 30 times earnings, Nvidia. I don't even know. I think it's got to be up in the, I don't know, 40s, 50s, 60s. I can't even remember. It's been so high. But the idea of like so many of those Magnificent Seven not only have performed extremely well, but have been pushed on valuation. And so if you're looking to get a cheaper exposure to the broader market, the equal weight has a lot more to offer in that regard over the next year, hopefully more than a year. So just a little tidbit for the end there.
Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.